In this video, I'll attempt to explain debits and credits in less than 2 minutes. You'll also learn my #1 accounting hack, dealer. Let's start the clock. What are debits and credits? Debits and credits are words that we use to reflect the double-sided nature of financial transactions. If you're new to accounting, these words can seem a little counterintuitive. But listen here, they aren't good, they aren't bad, they're actually quite simple, and they have everything to do with double entry accounting. What's that? Double entry accounting is a bookkeeping system. It says that every accounting entry must have an opposite corresponding entry in a different account. Why is that? Because at any moment in time, the stuff that a business owns must equal the stuff that a business owes. If we debit one side of this equation, then we have to credit the other by the same amount in order to keep it in balance. That means at any moment in time, the total debits in a business must match the total credits. But where do the words come from? Latin is the answer to that. Debit comes from debere, which means to owe, and credit comes from credere, which means to entrust. This is why they're often abbreviated to DR and CR. The original meanings of these words are a bit irrelevant these days. It's much simpler to think of debits and credits in terms of economic benefit. Here's what I mean. In double entry accounting, we have two main groups of accounts: normal debit accounts and normal credit accounts. Normal debit accounts increase when debited and decrease when credited. And normal credit accounts work the other way round. They decrease when debited and increase when credited. This is because every financial transaction involves a flow of economic benefit from a source to a destination. Normal credit accounts represent the sources that economic benefit flows from. They include liabilities, where a business borrows funds from a third party, equity, where the owners contribute the funds themselves, and revenue, where the business generates the funds internally. On the other hand, normal debit accounts represent the destinations that economic benefit flows to. They're made up of expenses, where a business incurs costs to third parties, dividends, where the business distributes funds back to its owners, and assets, where the funds are held as resources within the business. If we swap around dividends and expenses, then there's a simple acronym to help you remember all of this. Dealer, DEA, represent normal debit accounts, dividends, expenses, and assets. These increase when debited and decrease when credited. And LER represent the normal credit accounts, liabilities, equity, and revenue. These increase when credited and decrease when debited. We'll jump into a quick example, but first you might want to pause this video and note this all down. You can also find it on my debit and credit cheat sheet, which I'll leave a link to in the comments. Example: what happens if a business borrows $1,000 cash from a bank? Well, on the one hand, its liabilities have to go up to record its financial obligation to the bank, which is a third party. Liabilities are represented by the L in dealer, so they're normal credit accounts and represent a source of funds to the business. We can increase liabilities by crediting them by $1,000. In double entry accounting, every entry must have an opposite corresponding entry in a different account. In this case, the business's assets have to go up too. This is because the funds are being held internally as cash, which is an asset. Assets are represented by the A in dealer, so they're normal debit accounts and represent a destination the funds can flow to. We increase assets by debiting them by $1,000. As you can see, we've got a flow of economic benefit from a source to a destination. And now that you've got a feel for debits and credits, let me show you how to record them in different accounts. I cover that in this video right here. I'll see you there.